Hello and welcome to the Financial Bunny TV. My name is Nicolette Mashile. I am also known as the Financial Bunny. I'm very excited today because we're talking all things your net worth. Right, but before I get into that video, please do remember none of my videos constitute as financial advice. If you are, however, looking for financial advice, please speak to somebody who is certified and registered with the FSCA. So let's kick start. What is your net worth? First and foremost, if you don't know what the formula is for net worth, I want you to think about a graph that is going up because that is the trajectory of what your net worth should be doing, right? However, we are very much aware of the fact that people have, let's say, 4 different life stages. Age 1 to 20, you are still young, you're still growing up, you're in an educational institution, you are not making any money. Age 20 to 40, those we call your accumulation years. Now, in your accumulation years, the idea is that you're going to get into some sort of a job, you're going to start some sort of a business, and you're going to start contributing to the economy as best as possible. Then age 40 to age 60 are the years when you start preparing for your retirement. So more than just wealth accumulation, this is kind of your maintenance phase in your life. So you need to start paying off all of the debts, right? You need to start making sure that you've got assets that you can take into retirement that are going to carry you through. Then from age 60 to when you die, that is now your retirement years, your golden years. It is very important to understand that when you get to age 20 and you start moving from that second phase of your life up until age 60, your net worth graph should potentially be going in this direction. Now, the problem is many South Africans, theirs goes like this, like this, like this, like this, and then eventually it goes zhoops. So let's talk about a net worth. What is your net worth? Your net worth is expressed in a number. It is your assets minus your liabilities. So there's a question people like to say, what do you bring to the table? I bring my asset register, but you have to have an asset register for you to be able to have a net worth. Many people have just their body. That is the assets. And they go through age 20 to 40 with just their body. That is problematic because if you were to only just have your body, we would be fine. The problem is people are accumulating liabilities, which puts a lot of people's net worths actually in the negative. So if you're starting to work from a negative and you're trying to build up, but you keep accumulating debt, and let me tell you why people keep accumulating debt. It's because they get paid every single month. We need to take away this idea of people getting paid every single month because the fact that you get paid every single month makes you think that you are able to pay off debt. But in essence, you are creating a future liability that ultimately is taking a big chunk or a knock at your net worth. So it is absolutely important to understand that for you to be able to see whether or not you're making progress in terms of building your wealth, your net worth graph needs to have an upward trajectory. Yes, there will be bumps along the way. So it should have some sort of spikes going up, a little bit of going down, a little bit of going up. But just like if you actually want to assess whether a share price of a company is doing really well, what you will notice is that on the graph, there are dips, but they back ups, they dips. But the trajectory of the dips and ups and dips is still on a upward trajectory. So it's not going this way, it's going this way. So that's step number 1 in trying to understand this. Now, the reason I say this is think about it this way. If your take home is 20,000 Rand, take home 20,000 Rand. We're now in month number 8, which means that you have received at least 7 20,000 Rands this year. 7 of them. What is 7 multiplied by 20,000? So we take 2. We'll multiply it by 7, which we get 14, the thousands. So essentially 140,000. So you've made 140,000. 140,000. Am I correct? That math sounds very wrong. So let me quickly do it on my calculator because, I got an E for math. So, let's just be clear on what the numbers are supposed to actually look like, right? If your take home is 20,000 and we multiply that by 7 salary, yes, you've received 140,000. How much of it have you kept? I'll give you some time. How much of it have you actually kept? FNB came out with a study a couple of years ago that said South Africans take 4 days to finish their salary. 4 days. So essentially the salary comes into the bank account, hazards go on because it's actually yielding. It's yielding. It's not stopping. It's not resting in your bank account because there are so many things that already come and take that salary out of your bank account. You can't build wealth if you don't keep money. It does not matter how much money you make. People think that if they earn more money, somehow they're going to become wealthier. You're not. You need to actually keep money. Where do you then keep the money? You keep money in your savings and in your investments. So which means that you need to have the savings and investments for you to be able to keep money, or else your money sits in your bank account. And what do we say? Idle money is bored money. Bored money is gone money. You won't even know where that money has gone to. So it is absolutely important that you work backwards. What we're trying to do is to improve the net worth. Now, the net worth can only improve if your assets outnumber your liabilities. What are assets? Assets are savings and investments. So we got to go back again. As I say, this is the ultimate goal, is to build the net worth. But we got to move backwards and say, where lies the problem that creates a situation where people have more liabilities than assets is because we are not keeping enough money. In essence, what we're doing is we're creating future liabilities. And the more you create a future liability, if you earn 20,000 Rand and you create a 5,000 Rand future liability, you actually are saying, I now want to earn 15,000 Rand every single month. It is important to think about it that way. Okay, now you've got the money. Now you understand that you cannot take up any more future liability. Now you've got to invest and you've got to save. How do you pick the savings and the investments? You need goals. You need to understand that you need goals, right? And the nice thing about having goals, because remember, our goals are set up in 3 different categories. It's short-term goals, it's mid-term goals, and it's long-term goals, right? Short-term goals, mid-term goals, long-term goals. We've got the goal. This is A, this is B. B is the goal. It can be a mid-term goal, a short-term goal, or a long-term goal. It is going to force you to diversify. So you're not going to put all of your eggs in one basket. Why? Because where you invest into for a short-term goal, a mid-term goal, and a long-term goal will never look the same. It will never. There is no way you can tell me that there's a fund right now that can give you an outcome for a short-term goal, a mid-term goal, and a long-term goal. There's no such a thing. So, first and foremost, how you decide where to invest, it is dependent on those goals. So you've got to actually write them out and know, what are my short-term goals? Okay, my short-term goal right now is to go to Mauritius for my birthday, right? Work with me. My birthday's in September, but let's assume we're still in January in the year. So it means that I have 8 months to save for this goal to go to Mauritius for my birthday in September, assuming we're in Jan right now. My midterm goal is I want to pay off my mother's car, right? So that's a midterm goal. That's going to take me between 12 months and 3 years to pay for my mom's car. My long-term goal is I actually want to retire comfortably. So I need to make a certain amount of money for me to be able to retire comfortably. By the way, only 3% of South Africans can retire comfortably. So if you're in a room and there's 30 people, 3% of those people is how many people? Calculate and then look around and ask yourself, are you the one? So let's go back to the goals, right? If I'm putting money away to be able to go to Mauritius, I need that money to be accessible to me in 8 months. Therefore, the way I'm going to choose my investment is going to be different from what investment I'm going to choose if I'm saving money to settle my mother's car, which I have 3 years to do. So, step number 1, I need an investment that is going to give me probably cash as a return. Why? Because if I take up an investment that gives me an asset as a return or a capital gain as a return, I still need to be able to time the market well enough to sell that asset at a time where the market is going to be favorable to give me a price higher than what I would have paid for that asset. So it means that my options are probably cash. So it means I need to either look at a money market account or I need to look at an interest-bearing account. Because think about it this way. I can't take money, and it's probably a low amount of money, right? Going to Mauritius probably will cost me around about 25,000 Rand. So I need to save 25,000 Rand. So I need to make 25,000 Rand available in 8 months. So it means I'm probably saving, at worst case scenario, 3,000 Rand every single month. 3,000 Rand every single month. Where am I going to put that money? Where I'm actually going to get a return that is still going to, 1, capture the value of today's money in future, which is now in September. So cash is probably my only options. Can't go to the bond market. The bond market is fixed at a certain amount of time. Generally, bonds are between 3 years to 5 years. So bond market is out. Equity is definitely out. I'm not hedging my holiday to my birthday on a bunch of board of directors and a CEO of a listed company over 8 months. It's unfair. I can't expect Vodacom to grow in 8 months. It does not make sense. I don't even know what the market is going to do in 8 months. We all know that equity takes at least 15 years for you to be able to see some sort of, return on equity. I can't hedge it on property because 3,000 is not going to buy me a property. May buy me some real estate investment trusts, but let's be fair. Do I really expect a Mall of Africa or a Sandton City to be able to make that type of a return in 8 months? Probably not, right? I can't expect a Fed Group if I buy the macadamia nut. So for those who don't know how Fed Group works, Fed Group has what we call non-conventional assets. So imagine a livestock wealth. But let's come back to Fed Group, right? So Fed Group says we invest in macadamia trees. We are going to be exporters of macadamia from South Africa. Sharp, but we don't have the money to buy all the macadamia trees. So we're going to invite you as the public. You're going to give us a certain amount of money, and that money is going to buy you a tree. And then after harvest, we're going to take the macadamia nuts. We're going to sell them outside of South Africa. And whatever profit you make, you will get the profit based on however many trees you own. That's non-conventional assets. That's investing in macadamia nut trees, right? So I can't hedge that either because I don't know when the harvest is. So I can't say, I'm going to go on holiday in September. I'm going to put my money in macadamia trees and hopefully the harvest is going to kick in between that. It might not happen. But also, what happens if the trees don't give me enough fruit for me to be able to pay for a 25,000 Rand trip to Mauritius? So my options actually start to get quite slim. And that is why I say it's going to look different if I was investing for 3 to 5 years for a cash settlement for my mom's car. I can take that money and I can put it into some bond that has a guaranteed return. I know over the years they say to me they're going to give me 11%. I know for a fact I'm going to get 11% on whatever amount I am putting away, right? I've got 3 years to be able to do this. I can also go fixed deposit account. So my options start to open up because now my time period is a little bit longer. I can afford to take some level of risk because it's over 3 years. In 3 years, we're hoping that there is some stabilizing of whatever asset class that I'm putting my money into. If I'm going long term and I'm going retiring comfortably, now I know, okay, no, siyabangena manje. We're going aggressive. We're going for all of the asset classes that are going to do the whole thing about high risk, high potential return. Because I have time for it to really stabilize. And when I start to see what I'm getting closer to retirement years, I divest from the high risk, I put it into a more stable preservation type of fund, and then I get to retirement, siyaphila. So it is important to understand that that's how you then pick your investments. So for those who may not understand, let's take it a couple of steps back. You're traveling to Pretoria from Johannesburg. You need to decide which transport you are going to be taking. You've got an option between a taxi, the Gautrain, a private jet, an Uber car, or a private car. How you get to Pretoria will be dependent on what access you have. Do you have access to a private car? No. Do you have access to a taxi? Yes. Access to an Uber? Yes. Okay, actually today, I have enough money to take an Uber, so I'm not taking the public transport. But maybe I don't have enough money for an Uber, so I gotta take the taxi. So that's now a factor based on how much money you have to access a different type of investment. So let's take money out of the picture. You got all the money in the world, but now risk becomes a big thing. Let's say you need to get to Pretoria in an hour. You are writing a very big, important entry exam into a job. You can't afford to be even a minute late, right? Now all of a sudden, you're like, hey, I can take a taxi. But what happens if the door falls off while you are driving? What happens if the tire falls off? What happens if they get stopped by the cops and then they find out that this man does not even have a valid license disc? Now all of a sudden, you're assessing risk now. It's more risk. It's no longer about the price. It's now a risk issue situation. Or what if something actually happens along the way with this specific mode of transport that I have selected? The last one is also a time issue, right? I need to get there in a specific time. So therefore, my options might not be that flexible. If let's say I need to get to Pretoria in 30 minutes, then the private jet becomes the only way I can get there in 30 minutes. So time now becomes the other factor. So there are different factors in how you choose your investment options. Time is a very big one. So even with the short term, long-term, midterm, it's a time issue. Then you got to factor in risk. How much do you have to invest and can you afford to lose that money? Because let's be fair, there are people who cannot afford to lose even the 5 rand that they are putting away. Then there are people who are willing to lose it. So they're saying, you know what, I'll take aggressive. I'll take aggressive in the midterm, 3 to 5 years, and if I lose it, I lose it. Not a problem. The last thing is also tax efficiency, right? There's certain investments that you're going to pay tax on. If you earn, for instance, there was a lady I was speaking to, she's sitting with 500,000 Rand in a bank account, savings account. She's earning an interest. Currently, the interest rate is very high in South Africa. So she's earning quite a substantial amount of money. The problem is, she's now clocking that 23,800, which has been put as a benchmark there by SARS. So anything above that, she now has to pay tax on it. So if she wants to be tax efficient, she needs to come just under the 23,800, which means that she needs to actually halve that money. Take 250,000 Rand, put it in a high interest bearing account, take the other 250,000 Rand and put it in a tax-free savings account. Because in a tax-free savings account, she doesn't pay tax. Or what she could do is she could take that amount of money, buy an asset, right? So people are like, okay, but what about capital gains tax? Don't stress. I got the answer for you. If you put your money into, for instance, a property, you buy a property at 250,000 Rand. I mean, you can find something in the CBDs. Buy an apartment, 250,000 Rand. The only time you're going to pay tax is if you create a taxable event. If you don't create a taxable event, you're never going to pay tax. What is a taxable event? If you sell that property at a profit, the difference from when you bought it at 250 versus what you are going to get. So you buy it at 250, it appreciates to 500,000, you get a 250,000 Rand profit. That 250,000 Rand profit is subject to capital gains tax, right? The government wants their money. So what you do is you don't sell the property because then you're not creating an event. You take that property, you go to the bank and you bond it. You tell the bank, I'm not trying to sell this property. You give me money for the equity of this property. I will spend that money so that I never have to sell the property. But you can pull money out of it and then you pay the bank off. It's the cheapest money you'll ever get. Why? Because we know on a home loan, they're going to give you the lowest interest rate. So you've got to think about these things. You've got to think about what you're investing in. You've got to think about which factors matter to you so that you don't find yourself in a situation where you're not being financially efficient. And that's why we say it takes a different set of skills to make money. Anyone can make money. But the people who build wealth are the people that actually keep their money. I'm going to leave it at that. My name is NETWORTH Mashile. Remember, we don't give financial advice. If you're looking for financial advice, please speak to somebody who's certified and registered with the FSCA.